Have you ever thought about buying a car through your limited company? Wonder whether it's PCP, HP, leasing, or even paying cash is the best option? If so, you're not alone. Every week I speak to directors who are trying to save tax, but end up paying more than they should, simply because no one has ever explained this clearly in plain English. So today, let's break it down together. And by the way, my name is Samuel Ajala. I'm a chartered accountant and managing partner of Arthur Hamilton Accountancy. And my job is simple. I help founders and business owners stop losing money to HMRC and make decisions that actually benefit them. And that's exactly what I want to do for you today in the next few minutes. So let's start with something most people don't realize. When you get a car, the question is not, what did the car cost? The real question HMRC asks is, are you using it personally? And their definition of personal use is quite generous. So for example, if you drive it to the office, it's personal. If you pop into Tesco, that's personal. Even if the car is just sitting in your driveway overnight and you could use it, HMRC assumes you do. If the keys are in your pocket, they see that as a perk, and the perks get taxed. But here's where people get confused. You're not taxing the full price of the car. You're taxing a percentage of the car's value. That percentage is what we call benefit in kind rate, or BIK. And yes, I know that sounds like an accountant language, but stay with me on this because it's one number that determines whether your car costs you pennies or it's going to cost you thousands. So BIK depends on three things: the car's list price, how much it costs, its CO2 emissions, and whether it's petrol, diesel, hybrid, or electric. And that's where things get interesting. Right now, electric cars still sit at a very low BIK rate. Petrol and diesel cars, those rates are climbing every single year, and HMRC isn't shy from increasing it quietly in April when nobody's actually looking. So let me make this real for you. Imagine a company gives you a petrol car worth, let's say, £30,000. With today's BIK rate, that could easily cost you £3,000 to £4,000 per year in your personal taxes. And here's the kicker. You pay that every single year regardless of how much the car is actually worth anymore. Now, I want you to compare that with an electric car. Same price, same situation, but because the BIK rate is so low, you might only pay a few £100s a year, sometimes less than what you spend on a cup of coffee every month. Two cars, same value, but completely different tax outcome. That's why this decision matters. Now that we understand the personal tax side, let's talk about the company's taxes, because this is where the funding method becomes important. See, if your company buys an electric car outright or through hire purchase, the company can often claim huge tax deductions in 1 year or in year one. That's called a first-year allowance, and it can knock thousands off your corporation tax bill. If it's a petrol or diesel car, that benefit could disappear, and the tax relief is much smaller, spread out over years. Then there's the VAT. If the company buys the car, you usually can't reclaim VAT unless you generally never use it personally. And I mean genuinely. But if you lease the car, even if you do not use it personally, the company often reclaims 50% of the VAT on the lease payment. Small details, but it has big impact. Now you might be thinking, okay, Sam, I've heard everything you said. Just tell me which option is best for me. And the truth is, it depends on the type of car and what your goals are. If you want the cleanest, simplest setup with the lowest personal tax bill, electric cars through the company are almost always the winner. However, if you want cash flow friendly monthly payments, leasing works really well as well. If you want a big tax deduction and you know you'll keep the car, hire purchase can be a strong choice as well. But if your eyes are on a large petrol SUV or high emission car, running it through the business will always almost cost you more in most cases. In those cases, it often makes more sense to keep the car in your personal name and simply claim mileage from your company. That way you avoid benefit in kinds tax entirely, and your company still gets deductions. And this is the part no one tells you. The best option isn't always about the car itself. It's about your lifestyle, your tax position, and how you use the vehicle and what your company can claim. One director's perfect setup could be a terrible choice for someone else. So here's what I want for you. I want you to walk away from this video with clarity, genuine clarity, so you're not guessing and you're not leaving money on the table. Because once you understand the rules, you can actually use them to your advantage. If you want me to have a look at your exact situation, the car you want, the funding method, BIK or the BIK rate, and how much tax you'll actually pay, drop the word car in the comments or click the link in the description and I'll run the numbers with you and show you the best options for you and your business. Hi again, my name is Samuel Ajala. Thanks for watching and I'll see you in the next video. Take care.